Welcome back to the Everything Property Podcast. Now, we know most investors get stuck at 3 properties, let alone 6, but today's guest has not only broken through these figures, he smashed it out of the ballpark. Building a $26 million portfolio, he's now lent his hand at developing in some of Sydney's most expensive markets. Richard Morgan, welcome to the Everything Property Podcast.
Thanks for having me on the show, Dave.
That's all right. My first question, I guess, to open up with is, why doesn't someone like you have 30 or 50 properties worth $300,000 each?
It's a great question. I think ultimately we built our property portfolio over a long period of time. So I think in aggregate we got over about a 14-year period up to a peak of 14 properties. And I mean, ultimately everyone will hit a borrowing capacity ceiling. But for us, it was more about thinking return on capital and how to optimize both your capital and your borrowing capacity to get the highest yield. And so that meant moving away from just passive investing and buy and hold and moving into more active things like property development. And once you move down that path, it's a pretty hungry beast. So it needs a lot of capital, needs a lot of borrowing capacity, and that sort of led us to consolidate the portfolio a little bit over time.
Mm-hmm. Okay, well, Where did you first start? Like, what's your? I want to get into understand how you're able to get past sort of those 6 properties and on what you're doing now, which is pretty exciting. I myself are doing something similar, potentially 5 or 10 years behind you, but I see the value in the development side as well. So I want to understand. What was property when you first started investing? When was that, and what were those sort of first couple of assets that you bought? No doubt, maybe a dart or a wrong decision in the first couple. So tell me about that.
Yeah, definitely. A lot of mistakes along the way will be a common theme here. But I guess to sort of set the scene, the numbers now are pretty big, and I don't openly share this sort of stuff often. And the reason for that is, I just like to focus on doing the job and getting done what needs to be done rather than sort of talk about the numbers. And where I really want to land the message around my journey is that if I can do it, then anyone can do it. So I started, as per most people, right, just growing up as a kid in a normal middle-aged class family. We weren't in a position where we had terrible money problems. There was always food on the table. But, I saw my mum and dad working hard and I saw them struggle. And no matter what they did, it kind of felt like they could never get ahead. They were always sort of focused on money being an issue. And I think that sort of hardwired something in me when I was a kid to go, okay, when I grow up, I want to be financially independent. And I don't want to have these sort of stresses around money. So at a very young age, I sort of took it upon myself to go, okay, well, what do I need to do to become financially independent? And it sort of started with self-education, right? And I think a lot of people start with books. For me, it was books like Rich Dad, Poor Dad, trying to find more relevant books. I sort of knew I was into property. I just didn't know anything about it. So a couple of books that came out was Peter Span had a book called Wealth Magic. Probably showing my age here.
Did you get into any Margaret Lomas back in the day?
Didn't get into Margaret Lomas.
Okay, that was some of my first books.
Yeah. Peter Span, I think I liked it because he had a red Ferrari on the cover of the book, and was always into cars. But he had a real good story around property unlocking lifestyle, which I think really resonated with me. And then the other book was Steve McKnight. So I think he had a book with something along the lines of 0 to 130 properties. And so these stories were really relevant around how they built and scaled portfolios. Back then, it was different in terms of the lending picture. When these guys were building portfolios, you had almost unlimited borrowing capacity. But, there were still lessons that could be applied into where I was going from an investment perspective. And so, I took those stories, took that information, that knowledge, and sort of built myself up as a property investor in theory.
Yep.
Problem was, starting from zero, right? You don't have anything. You don't have any capital. There's no sort of free kick to get you into the market or anything like that. So I had to, take that information, step one, but step two, which I think is equally as important, is action. So going, okay, well, what am I short of right now? Well, right now I've got no money. I've got no borrowing capacity. I've got nothing. I'm just a kid. So what I'm going to do is everything that I can to put myself in a position to be able to get into property. Basically, normal school kid, all that kind of stuff. Got myself into uni just sort of scraped into the business course that I wanted at uni. But to be honest with you, me getting into uni, that was kind of secondary focus. I was trying to build, that sort of pot so I could go and invest some money.
Yeah, okay.
And everything I had, I just pump into managed funds and whatever else. Got to a position where, I was working 3 jobs at uni. Eventually sort of moved, different roles and tried different things out along the years. Found a car valet job in the city, which was fantastic. Got to drive a...
yeah, I was going to say, that's where you got in your veins, right? The
always loved cars. Always had, Ferrari or Lamborghini poster on the wall as a kid, and I never actually thought it'd be to buy one. For me, it was about financial independence and, trying to retire early and have the house paid off and whatever else. And that was really my goal. But having a job where I could drive one of these things was just, I think it was probably one of those moments that sort of tweaked a switch, within me and, sort of drove that motivation harder.
Yeah. Early taste for it, right?
100%. Yeah, it was a silver 360 Spider and it was a manual and it was brand new back when I was working at circa 2002. Wow. Just washing this thing in this car park thinking, this guy's got the life, he's got the car, I think he's a pilot or something like that. That's so aspirational for me. But anyway, I continued to grind. I think by the end of finishing uni, I was doing full-time uni at the same time as full-time work. And, doing everything I could to sort of build up that war chest with a deposit. I met my then wife, I think it was about 2002. She had already had 2 properties under her belt, so I thought, I really need to give myself a bit of a kick in the ass here. She's killing it, and I think that was a real moment for me to go, okay, well there are other people out there doing this. There are other people that are aligned to my strategy of trying to achieve financial independence. I think there's a side note there to go, if you can find the right partner on your journey, that's an absolute game changer. So I see a lot of people where husband and wife might have different financial goals or different risk tolerances, and it's really, really hard to navigate that. So I think that comes back down to building knowledge and then, in that relationship, trying to work together on joint goals financially and whatever else. Because, that can be an absolute barrier for a lot of people. But for us, we wanted the same thing, which was fantastic. And so at that moment, I've got a little bit of a deposit. Instead of going into property, I started importing cars with my girlfriend and trying to flip them and make a bit of money on the side.
Okay, what type of cars are you importing?
Well, they were Japanese cars, so things like Nissan Skylines and whatever else. And we'd bring these things in, and it cost us $10,000. We'd sell it for 12.5, and that process would take 6 or 12 months or whatever it was, and. So we made a little bit of money, had a lot of fun, but look, ultimately, I think it kind of stepped us back a little bit, or didn't step her back because she didn't end up doing what I did. Once I accumulated enough capital, ended up buying an R32 GTR, which was the car I really wanted. And
what happened to property, mate?
Yeah, I got so distracted, honestly, and I think there's a lot of lessons here around staying focused and being disciplined. I got myself to a position where I ended up landing a new role because of the pursuit of higher income and whatever else was leading me down a certain path career-wise. And then with that, I got an opportunity to move interstate down to Melbourne in 2006. And that was really the kick in the arse. I needed to sell the car and then buy my first property.
Is this you in your 20s sort of goofing around a bit?
Yeah, so 2006, I was 24. I'd say I got it out of my system, at least temporarily, with the car thing, and got my first property. It was just a 2-bedder in Richmond in Victoria. I had a pretty strict criteria around what I wanted to buy, and real focus on sort of having that continuity of rental income, being a high demand area, being an area that's got some growth potential. And so I lived down there in 2006 with work. I bought that as my first home. Deposit came from essentially the sale of the car and first home buyer's grant that I had back in the day. And that was my foot into the market.
Was it townhouse?
It's just a 2-bedroom apartment.
2-bedroom apartment, okay.
Yeah, just over 50 square metres. 2-better sort of...
small 2-bedder?
Yeah, it's a small one, but better sort of rental appeal than a single 1-bedroom. And sort of a lot of that learning I'd had early days with the books would be about, okay, well, if you buy an asset, what can you do over and above to add value? And I think that started, that accumulation of, or that acceleration of wealth creation more so than just a classic buy and hold. So, I did the basics when I owned that, just, carpet, paint, a few sort of cosmetic improvements. And when it came time to leave Melbourne and move back to Sydney, I kept all the furniture in there, had it fully furnished. The purchase price on that was $229K, and I had it renting out for $320 a week. So I think it's just over a 7% gross yield at the time, which is a good place to start.
Yeah, okay. What's your advice? Because I know I say it till I'm blue in the face, but we're going to have people out there and audience members that are in their maybe late teens, early 20s, late 20s, and they're looking at a Ford Ranger, they're looking at the C63, they're looking at the new cars because they want to impress and they want to fang around because their mates have got one. What's your advice to those sorts of people? But now they're listening, keep in mind, they're thinking about that, but they're also listening to podcasts like this, which they know the value of property, and maybe they're thinking about making a purchase. What's your advice to those sorts of guys?
Yeah, look, life's great. You get to make choices. And, I think if you're looking to indulge in something like a C63 at an early age, you're going to have a lot of fun with it, let's be honest. But it's going to set you back a long way on your wealth creation goal. So I think you've got to really commit yourself to the process and go, okay, with property and, buy and hold, especially, it's not a get-rich scheme. It's a get-rich-slowly scheme. You need to give it time, you need to be committed to it. But if you take that path over a long period of time, then you're going to find that you're in a position where you're financially secure. You'll be able to make those choices. You'll be able to buy the CCT3 then and have it not make any sort of difference on your financial position. Whereas if you go and do that early, it's really going to set you back.
Yeah. Do you find with the apartment that your value add strategies were limited at the time, or you thought what you could do was sort of enough to it?
There wasn't an awful lot that I needed to do to that particular property. I think, if you're looking at apartments, some of the stuff that we did in subsequent years in the inner eastern suburbs, so it'd be things like tweak a floor plan in an apartment and potentially turn a big one-bedder into a two-bedder. Mm-hmm. That can add a lot of value. Separate a living area, kitchen from the bedroom in a large studio apartment. We've done that before. There's a few little tweaks you can make to apartments, but generally they're pretty easy projects to execute.
Yeah, easy to execute, but also find limited options. I had a mate I used to go to uni with, and he had bought an apartment in Wollongong. It was recently renovated, and wanted a little bit of advice. Sent me a message. I said, "Oh, look, send me the listing. Let me have a look, a few photos." But it was a great apartment, 2-bedroom, but freshly renovated. And he goes, "Oh, we want some value add strategies and want to be able to increase equity." And I just looked at it and I was like, "There's no opportunities in the floor plate. It's a 2-bedder. It's been newly renovated." I was like, man, unless you want to there's not really much you can do with an apartment, it's not as if you can, add another bedroom and create, equity there. You can't, put a granny flat in the backyard or do anything external without going to the Body Corp or Strata Committee. So it's good, I suppose, you're able to have those little wins, but as well, I think for anyone that's listening and thinking about it, you just got to remember with apartments, you almost are limited to what you can do to value add on those compared to a home or something freestanding. I think when we go into the back end of your portfolio and the stuff that you've done in the eastern suburbs, and I've got other mates that are doing similar stuff now, is the 1 into 2s, especially in that higher range market, is a really quick way to add some equity. But when you moved up to Sydney, you kept your Melbourne apartment. What happens next?
Still got that Melbourne apartment today. So I think the rental.
Oh, you still got it?
Yeah, rental income. I think we're just renting it out now for $585 a week.
Wow.
So
any debt on that?
Yeah, there's a tiny bit of debt left. So I don't think. There's a tiny bit of debt left on that one, but certainly now with the sort of yield that you get, I think it might be worth $500K today. Melbourne's been pretty flat. So probably looking around about a 6% gross yield, which is pretty solid. But it's got a role to play in the portfolio. I think we've got some exposure in Melbourne with something like that. So we'll just hold on to it and play it out over the next sort of 10 years, see how we go. It's been slow and steady in relation to a few of the other properties in the portfolio. And I think, take your point around limited value add with an apartment. If I could have at the time, then I definitely would have bought a house, but slightly bigger price point, and I think a lot of people can't stretch themselves into a house.
Yeah.
So, you try and buy the best asset you can at the time with what you got available.
Yeah, true. What's the next purchase and where is it?
Yeah, so we ended up moving. Well, I moved back to Sydney. We bought a joint owner occupied together because we got engaged and got married and all that sort of stuff. That was a classic studio apartment in Elizabeth Bay.
Okay, good area.
It was a great area. Yeah. Again, it was the best
studio apartment for both of you.
Yeah, this is the thing, right? We had to buy what we had to buy as opposed to buy what we wanted to buy because we just, would have been nice to jump into a house or something like that, but really we couldn't afford it. So, we had a couple of investments under the belt that my wife had. We had mine in Richmond down in Victoria. I'd also gone and bought one in Queensland in Eagleby. I think at the time it was 98% LVR. So, you could do those sort of things a lot easier back then, as opposed to now you got limited lending options there for 98% for an investment. So, we'd started that accumulation. The owner-occupied place in Elizabeth Bay was, just a full gut cosmetic reno, same sort of thing, just a little bit more work, put a sort of partition wall in to create a one-bedroom out of the studio, separate living area and kitchen. So that played a role for us. We lived there for, a year or whatever it was and went, okay, you are right. It's a little bit long. It's a little bit small to live in for a long period of time, and you can kind of hear everything your neighbours are doing at all hours. So we sold up. I think it cost us something like $240K. We sold for $330. A year later, and that was a decent gain for us at the time. And we stepped up into a 2-bedroom apartment in Glebe.
Perfect. What drove you to invest up in Eagleby? I mean, if that's Southeast Queensland corridor, it's done phenomenal now because that had a really good run in and over COVID. But what was the decision to go up there and how did you sort of find and locate that property back in those days?
Yeah, it was a very different environment. Today you've got so much data, so many opinions, everyone knows where to invest or supposedly tells you where you should be investing your money.
Everyone's got a podcast.
Everyone's got everyone's got everything, right? Yeah. And I think, to be honest, a lot of people get confused and, that probably creates, denting confidence around what investors should be doing. And, it's analysis paralysis, right? Back then, there really wasn't that much information around, where should you be investing and whatever else. So, we identified that area being sort of a bit of a growth corridor between Gold Coast and Brisbane and very, very cheap in relation to, if you look at what prices were in Brisbane at the time. So we ended up picking a couple of places up in that same sort of location. Over the years, sold one, kept one. But it was sort of that attraction of, okay, well, over time there's jobs, growth, investment going into the area. This should hopefully over-index in terms of growth. Got to be honest, it was incorrect. Made a mistake on the call there. One asset.
To buy there?
Yeah, we could have bought somewhere else and had higher levels of growth. Yeah. If I go back, the one I bought had a compound annual growth rate of about 3.5% over the 15 years that I held it, which was the biggest dog in the entire portfolio. Really? Yeah, it was not a good property.
Was it a house?
It was a house, 4-bedroom house.
Yeah.
It was on a small block of land. And the timing in terms of when I bought it was sort of like a peak of the market.
Did you sell prior to COVID?
I sold 2021. 2022. Yeah. Okay. So, but I think up until 2019, I reckon it was probably worth near what I bought it for.
Yeah.
So Queensland didn't have an awful lot of growth, in particular those sort of areas where there were higher levels of supply. A 4-bedroom house on 400 square metres of land, there's no real value add there, right? No one's going to be able to put a granny flat on the back of that. If you had bought something, perhaps with a big block of land where you could add value and sort of think about maybe future development, then there would have been more upside in asset growth. But, I just bought the best asset I could with what I had at the time. And I wasn't really focused on, thinking about those longer term factors.
Yeah, true.
It was more about, this is a buy and hold strategy. We just got to accumulate, buy assets. And you learn over time, right? And you make those mistakes. So I didn't really have anyone on my shoulder telling me, here's the criteria you should be looking at when you're buying an investment. We had an Australian Property Investor magazine, which was kind of like the peak knowledge body, right? There wasn't really the depth of information that we've got now. So
I used to get them second hand, passed me down from my brother back in the day. But I mean, it sounds like you're learning anyway, right? Because like the first one's a apartment, then you've went a house, and then you've realised, look, the house is. In hindsight, that the house isn't on a big enough block, and that's what killed me there. So what are the next sort of learnings, and how do you turn that into the rest of your portfolio? Are you growing your income on the side as well in your job, and are you stepping up in that corporate world to be able to save for these deposits, or are you extracting equity? I know that you're buying like that. You said I think it was a 97% lend. So how are you accumulating the deposit for these back in those days?
Yeah, great question. So we were pretty much at every single point of the accumulation journey pressed on something. So we'd either run out of borrowing capacity or we'd run out of capital and equity. So it was a constant battle to sort of try and problem solve, which is why I sort of ended up being a mortgage broker, because having that personal experience of trying to solve these problems constantly over time and finding a way to overcome them is real rewarding, obviously, when you're doing that personally, but also professionally now. So there were big implications, right, in terms of, okay, if we don't have the serviceability to make this happen, we need to do something different. And I think a lot of the tweaks that we were making, so, we had ended up accumulating some apartments in Sydney, in the eastern suburbs, and the people that would look to rent those sort of apartments, you had a lot of tourists, you had a lot of students, and, they were looking for fully furnished apartments. So we could generate a premium return having, $2,000-$3,000 of stuff from Gumtree sitting in the apartment fully furnished, and that in turn would aid our borrowing capacity. So we're doing a lot of little tweaks and controlling whatever we could to try and optimize our position. But ultimately for me, it was, focusing on career and really pushing that as far as I could. So at times, uncomfortably, asking for a lot of pay rises, pushing for promotions, leaving, going from one company to another, just to try and get a $20,000 or $30,000 pay increase. Basically, my role in the PAYG role, my role was to push the income as hard and as high as I could so that I could invest and buy more property to grow wealth.
Yeah, okay. What are some of the pockets, and what are you buying for in and around the east?
So we bought a few apartments in Darlinghurst. We also did a few flips. So
talk to me about some flips and some numbers there.
Yeah, really really simple stuff. So back in the day, buying an apartment in Potts Point, it'd be a studio apartment, sub 30 square meters, tiny, but just needs a cosmetic renovation, right? And if you could buy well. We had a crack at so many different places, and some of them worked, some of them didn't work in terms of offers and whatever else. And example of one I think picked up for about $140,000.
Wow. Okay, so we're going back a bit of time into those pockets, right?
Yeah, correct. And with terrible condition, and nothing that sort of liquor paint and some sandpaper and some flooring and whatever else. You could end up making not a lot of money, but to be honest, it was all about just building as much as we could. So we would make maybe 30 or 40K on a flip like that. So turn a house of horrors, a little studio apartment, into something that looked really nice. There was definitely a market for that sort of thing. So we did whatever we could, whenever we could, when we found an opportunity in the market, and sort of a clear path to profit. But it wasn't easy. It definitely wasn't easy to find those opportunities.
Are you doing all the work yourself?
I'm pretty useless when it comes to the physical stuff. I've got to be honest with you.
Yeah, I was going to say, and honest.
Yeah, so we would outsource to trades, and sometimes they wouldn't be the most capable trades. You have to keep a bit of an eye on them, but we'll always focus on trying to minimise that bottom line and get the job done.
So is there anywhere you were learning and picking up this knack, or is it more just do one project, take the learnings, move on to the second, move on to the third, and try to get better and better, and flick the trades and bring on new ones? Or how did you refine this process?
Yeah, so I think for us it was a lot of learning by doing, and we'd make a lot of mistakes along the way, identify better ways of doing things, and sort of evolve what we're doing. So we didn't really have a team around us. I think would be one of the things that I look in hindsight and go, how could I have accelerated my journey? How could have I done this differently? How could I have done it better? If I had the right sort of team around me that could add value and give me advice, people that have been along that journey before, then I think we would have made a lot less mistakes and we would have got to where we are today a lot quicker.
What are some of the is there any big mistakes that were a huge lesson for you that you can share so, our audience doesn't make the same?
I think, there's some stuff there with asset selection. When it comes to buying, houses, you want to think about, the long-term growth and picking the right asset. So that example of a small block with a house on it in an area where there's a lot of that, very hard to differentiate. If you can buy something that has future potential around development and whatever else, it's going to be a superior asset. So, that's definitely one. But really the biggest learning we had was when we were trying to leverage off the back of, doing these sort of cosmetic renos, being successful passive investors and then moving into the development world. That's probably where we had our biggest learning. Yeah,
tell me about this. So when does the time come where, is there a point or is there a moment where you've done enough of is it like you've done enough of these flips, you keep going, or is it to get to a particular purchase or goal, or when is that sort of sliding doors or big moment with this, buy, reno, flip sort of journey?
Yeah, so we've done a few flips, we've done a few cosmetic renos, we've got a fair few properties under our belt. I think it was about 2010, 2011. We thought, perfect. Now's the time to go and do a full-blown development. Now,
okay, yeah.
Now in hindsight, there were so many lessons in this, right?
Great.
I mean, we understood the theory of property development. Kind of understood. Okay, well, we're going to go and buy a raw site in Hurstville. It's on a big block of land on a sort of major road. We know in theory you can get 4 townhouses on it, maybe more. So it was $1.1 million at the time, which was a lot of money. I think we had sort of like a net wealth of about $2 million. So it was a big play for us. And off we went, jumped into it, bought it. I bought it on my birthday.
Was there a house there or something on it?
Existing house.
Yep.
Terrible condition.
Yep.
I think it was renting out for something like $250 a week.
Okay. Wow.
So not optimal. So we thought, okay, well, that's all right because we're going to jump in. We're going to get a DA approved. We're going to get 4 townhouses. We're going to build it and then we're done.
Corner or normal block?
Normal block, just really big. So it was on Croydon Road in Hurstville, opposite I think Bexley Golf Course. It was just a nice little spot there. But anyway, we jumped into it and we didn't know where to start. We didn't know what we didn't know. So there was so much that we learned through that process. Engaged some architects to do the plans for us. It all looked pretty good to us. We weren't really experts in that sort of domain, right? So we trusted these architects to get the job done. Anyway,
how did you find the architects?
I can't remember how we found them. Okay. It might have been a combination of Google and having a look at their prior work and whatever else. And they sounded like they knew what they were doing. They sounded like they were very confident. But effectively, 18 months later, we were sitting there having been rejected by the council 3 times for what the architects
18 months?
Yeah, it was terrible.
4 townhouses?
It was terrible.
Oh, you hate to hear my record, mate. I've never had anything take 18 months.
No, and fingers crossed you don't. Yeah. But you definitely don't come across as a first-time developer. We had no idea what we were doing, and we assumed that the architects did. And it was only in hindsight when we were able to find a draftsman who knew the council rules, knew what we were trying to achieve, and had a quick look at the plans, and he went, "This is never going to get approved." So that was deeply worrying because 18 months of absolute burn in terms of holding cost, DA costs, the cost of the architects. We gave it to the draftsman within 3 months. We had the DA approval.
Wow.
But we were so burnt out from the experience. It was very stressful. We didn't want anything to do with this thing anymore. And it looked like interest rates were going up at the time. So it looked like Sydney was going to struggle, asset-wise with property prices. So we went, okay, let's just cut our losses. We ended up selling it for 1.08 mil. So we took a 20K haircut on it.
Plus holding, plus
agent. It was a complete debacle. So I think it cost us about 250K. Mm-hmm. So at the time, that was a lot of money for us, and it really hurt. But it was a lesson all the same.
It is a quick little one I'll drop for everyone that's listening and thinking about doing that is jump on the council that you're thinking about working in's website and go to the section of that council's website where they have the DA and the approval stuff, and then you can, if you watch it for long enough over a few months, you can start to see all the DAs that are submitted. From there, you create a spreadsheet and you say who is the entire project team, and then you're going to find that there's going to be some architects and some consultants that get the DAs approved really quick out of council, that know the council officers, that know the legislation, that know all the tips, tricks, and how to get things across the line. That would be my tip to finding the architects. I'm sorry I couldn't tell you that any earlier. But the interesting thing is that you didn't give up in development, right?
Correct.
You got burnt, you learn a lot, but then I'm assuming you go into your next one.
Yeah, exactly. So expensive lesson, but a lesson all the same, right? So we went, okay, well, what can we do from here? What does our journey look like? We thought, okay, well, let's not just completely give up. We still got aspirations here. We still want to build wealth through property.
Good on you. Yeah.
And we went back to basics. So we were like, okay, well, what's the sort of least risky thing that we can do? What fits within our wheelhouse? What can we control? And that sort of self-evaluation of of what's possible and what we're comfortable doing. So we ended up going, okay, well, we'll buy an owner rock in the inner west, and we just picked up a small sort of semi. At the time, it was about 725K purchase price. The plan was to turn it from a 2-bedder, 1-bath to a 3-bedder, 2-bath. So upstairs extension, full cosmetic renovation downstairs, a bit of landscaping, pretty simple stuff. The house was a complete wreck. It had holes in the roof and snails falling out of the holes in the roof. It was classic hoarder house. So none of that stuff really fazed us. It was more about, okay, we can see a path to profit. What we need to do is a DA approval. We've now got a draftsman on board. He knows what he's doing. He can do the plans for us. He can get the approval. And then it's a matter of sort of trying to network out and find the right people in terms of trades. We built a bit of a network from the cosmetic reno stuff. But actually get a licensed builder to do the work and whatever else. And sure enough, we were able to actually execute that job, without having any sort of major issues.
Were you living in it at the time?
We were. It was,
wow.
And toward the end of that process, my wife was also pregnant. So,
were you guys aligned and on the same mission when you obviously bought the dump and it was like, we need to sleep here and this is where we need to live? Or were you aligned there?
Yeah. Look, we did the work downstairs first, at least the basics, in terms of the downstairs bedroom and, whatever else, just to get into a livable condition. And then when we did the extension, essentially we had like a sort of like a cricket net set up where it was a bunch of different plastics where you had to walk in and walk out from where the living space was to where the work was being done. So it wasn't too bad, but I certainly would never do it again. I think, we're willing to sacrifice a lot of things and say no to a lot of things and be uncomfortable with a lot of this stuff. But that's probably an experience I'd never do again, particularly now we've got kids and whatever else, right? So it's impossible. Yeah. But we lived through it. The work, it all came together really well. I think the finished product was, sort of acceptable. You look back at it now and go, oh, geez, probably would change the level of finishes and
Of
whatever
course,
else. But
yeah, at the time.
at the time, it worked well. We ended up selling it for 1.36 mil.
Okay.
I think about 18 months later.
Wow.
Again,
Not bad.
pretty healthy margin.
What's
right?
your sort of costs back in those days?
It only cost us about 250K. So
Okay.
I think we're roughly 385K in the money there.
PPR too,
PPR,
living in it.
correct.
Yeah,
No-
cool.
no tax.
CGT.
Yeah, and it sort of came about where we went, okay, well, we weren't intending to sort of do it and flip it straight away or anything like that, but we went, okay, well, we're going to have an expanding family here. 3 beds is great, but, we really need a 4-bedder. So we thought about, okay, well, let's keep our eye out. If there's another opportunity to do exactly what we've done here, let's do it again. And so, we sort of leapt through that process and did it all again.
In the West?
Yeah, in the West. Similar sort of numbers, slightly bigger project. Again, we're leveraging the team that we've got, right? We've got builders, we've got draftsmen, we've got trades to pick and choose from through, building that network on the previous one. So it was pretty seamless in terms of rolling that process out again. And I mean, aside from navigating some issues with the DA, with neighbours and that sort of thing, which is commonplace anywhere, it was a pretty smooth process.
And so at this time, what's sort of the goal in the investing journey here is the PPR play, the huge reno value add. Are you adding to the investment properties, or you've just got sort of your partners couple, you've got the one at Queensland, Melbourne, are you just sort of leaving them to bake and grow? Or
so we'd accumulated, I guess, in the background as many as we could, right? So we'd diversified across Queensland, New South Wales, Melbourne, South Australia. At that point, we had a peak of 14 properties, which was right about when we'd finished the most recent PPOR build. I think all up, it was a portfolio worth about 5 mil. So it was pretty healthy. We had a lot of sort of money in the bank as well. So things were in a pretty comfortable position. But I guess the sort of trigger point there was going, okay, well, we've stuffed development up massively. Now we've gone back to basics. We've kind of proven to ourselves that we can actually make this work in a small scale with low levels of risk. It's probably time to have a crack again and see if we can do another property development.
Was there, how many of those do you do? Was there any that did you then dive into another development side, or was it just always upgrading the PPR?
Yeah, so it was a big...
Taxman is an issue if you keep doing that. So.
Well, correct, yeah. And look, at that point, then we've got 2 young kids. We don't want to be moving from place to place too frequently. So we looked at it and went, okay, well, we can find some duplex sites and in the inner west, and it's a market that we can get into that I think probably not everyone can afford, because it's quite a sort of big entry point around that sort of 2.1 mil for a single site. And that was a big sacrifice for us in terms of being able to jump into that, because we needed to feed the beast. We needed the borrowing capacity and we needed the capital.
Yeah.
And the only way we could do that was sell the owner occ and then move into a rent vesting strategy. So we rented a really nice house up the road. Effectively, it cost us what the holding cost on the owner occ was anyway. So that worked out really well.
Yeah.
And then, went all in, I suppose, with borrowing capacity and capital into that first
duplex project?
First proper duplex project.
Okay. Well, now you've moving into a duplex, you're changing up the development strategy, you're changing up development type. You've got your trades, you've got your team, which is great, but it's a whole nother beast. So how did that pan out?
Yeah, that was a completely new process again, but we knew a lot now. We'd learned a lot from the failed development. We'd learned a lot from the DA projects that we've done as owner occ. We'd got a new builder on board, which was probably the biggest new moving piece. And honestly, we must have interviewed about 50 of them to try and find one that was a fit and a good builder, but also economical to make the development make sense. And
how did you find the right builder? Because a lot of people sort of can say the right things, but is there any questions that you're asked that, pulled up red flags or disqualified any of them?
Yep, good question. difficult process, I think, especially, if you've not done it before. So, we had our plans. So the plans were really easy to do because it was a unique site. So it was a 2-lot. You could actually do CDC, 5-bedroom one side, CDC 5-bedroom the other.
Yeah.
So we just did the plans with the draftsman.
Attached or detached?
Well, technically, I think they're detached.
Yep.
But I think there was some wall in the middle for whatever fire reasons and whatever else. So from an approval perspective, being CDC was really, really simple. There were no DA conditions,
How
no
much
complaints.
better is the CDC pathway, huh?
Amazing, right? That was
spending 18 months to the DA, yeah.
yeah. I think we had a lot of complaints there, and look, I understand that. If you're living next to something that's being built, you probably don't want that to happen. But ultimately, I'm not going to say we're trying to solve the housing crisis here, but it's all progress, right? Now we had the CDC plans. We could take that to tender with builders, and I guess where we started first and foremost was on price. Okay, well, there's a certain amount of builders that we're talking to that just cannot meet anywhere near the price that we're looking to deliver the project on. So we can't use them. It's just not feasible. And then, I think we ended up picking out 3 or 5 that we sort of filtered down on, and then went through a more detailed process to understand, okay, well, what's it going to look like? What are the level of finishes? What are we looking at timing wise? Just really narrowing down on the nitty gritty. And I think we narrowed it down to 2. And we went out and had a look at some of their projects that they built. And got a bit of a feel for who they were as well as a person, because, you have to work with this builder day in, day out for, 12 months or 18 months or whatever it's going to be, right? And so we picked one off the back of that, and thankfully it was the right choice.
Well, okay. And then how did the build go? How did the project go? What are the sort of the numbers,
Yeah, so this one was done properly from the start. We'd incorporated a company. Everything had been properly structured. The lending was done properly. The builder, the plans, everything was the way it should be. Which was
so just quickly, structure PTY Ltd.
PTY Ltd. Yep, correct.
And are you buying that as an investment or a development site?
Yeah, so that one was essentially bought as an investment. So, we were able to get 60% gearing, which is effectively land value. And the reason that we needed to sell the owner occ is we couldn't borrow any more than that. But it was handy in that regard because it meant we had cash available for the shortfall and we had cash available for the build. So the build and total costs, what that cost us about, so I think the build and total cost was about 1.1 mil.
Wow.
The land was about 2.1. Yep. So add in about 100K of, I think, selling costs over and above that. So ended up at about 3.3.
Yeah.
Sold out for maybe it was.
You got a bit more. You got other costs on there. Maybe you're in for 3.5.
Yeah. I think all in we were in for about 3.4 mil.
Yeah.
And we ended up selling them both roughly for a total of 4.5. So over an 18-month time horizon, that was a great result and a complete game changer for us because, we've gone from a position of completely failing development to, about 5 years later, we've got our first project that we started from scratch and it's been successful. The numbers are fantastic, probably beyond what we thought were achievable. And so confidence was back.
Confidence was back. What timeline are we talking? Is this early 2010s?
No, so yeah, we did the initial one in 2010.
Yep.
So I think it was about 2015, 2016. This one came about.
So this is why I love development so much, is because in that 18-month window, you've generated $1 million gross, but obviously it's in the PTY Ltd, so you're not paying too much tax on it. $1 million in an 18-month window, whereas if you were to make that, for you to have that in a property portfolio, not only would you need to have had, a $10 million portfolio that did 10% across all your assets, but even then, that's not realising that because, you've got to cash it out and pay stamp duty and all that kind of stuff. So it's like $15, $20 million portfolio and everything to do 10%, whereas you've just been able to go out and go, no, one project, and then God, let alone, scaling and going into the next, is that you can pull that $1 million out. You can invest, you might invest 400 in, a commercial asset, and then you might go, all right, 600 is into the next project. And it's sort of this big tree that starts off with one project, that goes into 2, that goes into 6, that goes into 8. So I'm interested to hear how you then scaled out, or then what was your priority with money and property then at the time, having made this large chunk of profit.
Yeah, it was definitely one of those moments which was a game changer for us. And we're going, okay, we can make good money. Here I am sitting in a PAYG role making, let's be honest, nowhere near that amount of money, and absolutely hating my life. The career's gone from a position where I'm in roles which are all about being, an individual that delivers results to, being in more sort of senior management roles where it becomes more about the politics and delivering results. And I know a lot of people in those roles, and they are fantastic at what they do. It's just not me. I think I'm hardwired to work hard and deliver results and just focus on getting the job done rather than the politics. So, and I think, a lot of us that are doing our own thing, right, that's the moment where you actually find that and you get out to that space and you go, this is awesome. You can make your own, you can do whatever you want.
Yeah.
So at that point in time, I've gone, well, this development gig, if I can continue to do this, I don't need this PAYG role anymore. I've now got income, through this PTO LTD and, whatever else that we can now scale for borrowing capacity so we can continue to invest. So I'm going to pull the pin. I pulled the pin on the career and, the cushy PAYG salary and all that kind of stuff, and decided, well, I've got to do something, and I want to do something in property.
Hang on. Before we get into that, talk to me about the mindset. Talk to me about do you remember the day you handed in the resignation?
Yeah, I do, yeah.
Tell me about it.
Geez, it was a satisfying moment. I got to be honest with you. It's
for those that are only listening, Richard's got this massive smile ear to ear, and yeah, it's funny that you got to check this out on YouTube. But yeah, okay, it's extremely satisfying.
Well, I've been thinking about it for a long time, right? I mean, it was 2008 I started thinking about, I want to do something in property, and I always loved the analytical side, right? I had a history in FMCG industry, in sales. So, I knew how to run a business, knew how to generate business, all that kind of stuff. But I'm more the guy that sits behind the keyboard than the guy out, selling beatings chest, kind of old school sales guy, right? So the analytical side of property always appealed to me. Trying to push borrowing capacity, trying to find solutions, trying to find a way to sort of accelerate the portfolio. That was always the challenge that I sort of sat behind the Microsoft Excel, trying to crunch the numbers and go, how can we do this? How can we make it happen? And so I thought, one day I'd love to become a broker, and then, go from 2008, I can't do it because we're wedded to my PAYG salary. We need that. That's the role that I play. And then, circa 2016, I think I've gone, okay, well, we can actually do this now. And a few years prior to that, the thought wouldn't exit my brain, and I was thinking, I need to find a way to do this. And I think that drove a lot of the decision-making around trying to make that push back into development to try and find some sort of way to replace my income. And so, the opportunity obviously has now presented. We were able to pull the pin. I'll never forget the day. I remember it vividly. And, I feel sorry for my boss at the time because, I had people resign and, it's not a fun process. But,
Walk us through the day.
It was the feeling of this accumulation of an entire career and wanting to get out, and it all came down to one day. And my boss was down in Melbourne. I was up in Sydney, and so I booked a flight down and catch up, and had a little envelope sitting there in the lounge having some crumpets and coffee, and had this little envelope just sitting there, right? And I just had it on the table in front of me. I had it in my hand, and went down to Melbourne, caught up with the boss, and said, "Sorry, mate, I'm not your guy." And he said, "Oh, why not?" To try to talk you back into it. I said, "Look, I'm just going to go and do something completely different." And I think he was quite shocked to go, "Okay, well, you're going to go and run your own business. You're going to be a mortgage broker. You have any idea what you're doing?" well, not really, but that's okay because I wasn't transparent with what I've been doing with development or anything like that to the people around me at the time. But I said I'm going to be okay. So it was just that feeling of a massive weight off to go, okay, well, I'm no longer under pressure here. I can live life on my own terms, and we've reached that point of this is it, right? This is financial freedom. I'm now doing what I want to do, when I want to do it, and how I want to do it, as opposed to on somebody else's terms.
Yeah, perfect. And I resonate with all of that because I've done the exact same thing. So in terms of structure, you're leaving, you were then paying yourself a salary out of that PTY Ltd whilst you then train up to become a mortgage broker and start that business, because obviously there's some learning and some, you've got to generate business there. Is that sort of how you structured things, or?
Yeah, so I guess, we had accumulated profits in the PTY Ltd. We had money that we'd lent the PTY Ltd, personally, so that came back to us. We had enough of a nest egg there. We were investing. Cash flow was good from the portfolio of properties. At some certain points, I can't remember the specific milestones, we'd sold a couple down, to sort of reduce debt and whatever else. So, overall, the portfolio was delivering us positive cash flow, which was good. But really, it's the big focus was driving that chunk income through the development. So, I was sitting there at that stage going, well, actually, from a business perspective, being a broker, this is only going to be a part-time thing. I'm thinking 2-3 days a week.
The broking?
Yeah, absolutely.
Yeah.
I don't need to work any harder than that. We've got all this development income coming down the line and property's going well and we've got passive income. So I'm looking to work-life balance here, spend more time with the kids, lifestyle, all the good stuff, right?
And you know as well with development, I like the low to mid-rise stuff too, because your DA's only really a month or two of work at that scale. I've worked in the higher end where, it's 150 up to 500 apartments, and your DA's there a few $100,000, 3-4 months, a lot of work. But in this little small scale, it's a few weeks of work, but it's not. It's just you coordinating, checking plans, right? Your architect's doing it, you get it back, make sure, everyone else has a look at it and goes in. But once you've got if it's a DA, once you've got that in, or once you've got the boys on site, you're checking in at site once a week. But apart from that, it sort of frees everything up, right?
Correct. If it works well like that, and sometimes it does, sometimes it doesn't, depending on your team, right? Then happy days. Really, it's great profit. It's not hard work, but it is a lot of risk. So at that stage, we've taken on the next project.
Yeah. What's the how many? This is 2015. So if you're looking at 2 years or 18 months of projects, you've had 3, 4, 5 of those now, right? So how have you sort of stuck to duplexes? Or
yeah, we stuck to duplexes. We've we accumulated the next one before the prior one sort of finished up. And
how did you do that?
Well, we ended up buying and then settling on a longer settlement. We bought because the CDC thing was such a game changer, right? We ended up buying a DA approved site. Did the numbers on it, the FISO worked. So went, okay, well, it's a DA approved. All we need to do is take the team from one site, go straight into the next one. Right, dream, right? And you know what? It went pretty well. So we had some unforeseen side issues with.
Is this still in Inner West?
Still in Inner West, yeah. So really, it's almost copy paste, slightly different design and whatever else. But we had some side issues with. I think there was, don't quote me on what it was. It was like something to do with water and pipes and whatever else at the back of the block.
Sewer diverging.
Yeah,
like that.
Which wasn't part of the plan. Cost us a little bit extra money to fix that, and then the project took a little bit of extra time. But you've got to continue to see. So that's all sort of contained within that, which was fine. We're thinking here, it wasn't as nice area as the other one. We're thinking the end product should be worth about 4 mil
each,
2 mil
both
side.
2, yep.
And similar sort of acquisition numbers. So we're thinking, this is going to be a pretty good project. Something happened that weekend that we hit the market. So Saturday we had something like 17 groups through, fantastic price feedback. thinking, okay, Monday morning we're gonna
We're on here.
we're gonna make this happen, right? Started to think about maybe I can buy myself that silver Ferrari finally.
Already? Shit.
And Sunday, I don't know if anyone remembers this. It was about 2018, I think was the year. There was a 60 Minutes article called Bricks and Slaughter. It was by Martin North, and it was the first time he's really hit the mainstream media, beating the drum saying property prices are going to drop 40%.
Oh, yeah.
And I've never seen market sentiment change so quickly.
No.
By the time all the callbacks were done Monday afternoon, we had no interest. No one wanted to touch it. So we really struggled with that campaign. The problem was we were all in. So all of our capital, all of our borrowing capacity, everything had gone into this project. And the way that we had it structured, it's not optimal to sit there and hold and wait for the market to get better, because we need that borrowing capacity. We need that capital to go to the next project to try and do it again.
And you're at peak debt too.
Correct. So we had no choice. We had to meet the market. And, we tried a couple of different agents to make it happen. But unfortunately, at the end of the day, I think we ended up getting something like 3.2 mil.
Wow.
For the project. So an 800K gap on where we wanted to be, it hurt us a lot.
Man, this is the thing with the media. It's like same thing happened at the start of COVID, and it's like for a reason I do not get and understand. I get it and understand it, but like so many people I feel like are just fed the media lies, fed the media bullshit, and the pack moves as the herd. And it just is, if you can just in your brain, I can't even tell you the last time I've watched the news, but if you're listening to this and you either believe or you listen to like gospel, those news and media outlets, and the fear mongering that they put out there constantly with interest rates and house prices, like you're gonna just get the same results as 95% of people, and it's just does my head in. And I've only got such a small platform compared to 60 Minutes on a Sunday night. Every family in Australia has got that on, and then mum tells the kids tell their friends, and it just spreads like wildfire.
Yeah, it was, I think back then in particular, people were really embracing that as, okay, that's fact, right? I think these days people are sort of challenging mainstream media a little bit more and trying to form their own views. But I think, largely mainstream media still has a massive role to play, right?
Got to talk to your builder. If you were 1 week...
honestly felt like that. If we were 1 week, 2 weeks, like if we didn't have that delay, sliding doors moment, we would have got good money for the project. And I don't know what would have happened, to be honest, because that was another moment where things shifted. So, I was sitting there as, part-time broker, part-time developer, part-time long lunch expert. I wasn't doing an awful lot. But because of that, we made no money on development. I'm making pretty much no money doing broking. My wife, she's always the sort of project manager on site, so to speak. She's making no money through development. We got a little bit of money coming on the side so we can survive, but we're sitting here going, oh, what have we done? We're at rock bottom again.
Yeah, fuck. Well, this is 2018 and you've probably just covered costs really with if you're selling out for 3.2.
Correct.
Or maybe a small loss, but you are the timing is very unfortunate because everyone knows what happened in 2019 and 2020 Australian property market. Correct. So I'm very interested to hear what happens next.
Well, it gets worse than that, right? Because we didn't make any money in a development company, we now have no income for borrowing capacity. So we can't even jump back into the market to recover.
Well, but okay. But isn't that a cover your cost, but you would still have... You don't have any of the profit from...
It's no profit. Companies
from
making
from
profit.
the first one. From your first one? Is there anything...
Ship sailed on that because of the timing of the projects. Yeah, okay. So, that company then doesn't have a profit for the year. We can't borrow off the back of it. There's really... We're thinking, what are we going to do? Fortunately, a few things happened there, right? So I put my foot on the gas when it came to the broking business. Said, okay, well, it's time to invest, time and becoming the best broker you can, build that business up and have a source of cash flow there, right? We started a property management business as well, Progressive Property. My wife runs that. That's now built up to a team of 5.
Wow. How many properties?
About 300 properties. So,
wow.
But it's on a growth trajectory. At the moment, they're growing pretty strongly. We're looking to add on some bits and pieces there with acquisition and whatever else.
Mm-hmm.
And then the third thing was that it forced us to get creative around, okay, well, what can we do? How can we make another project work? And we ended up in conversation with some friends of ours who were in the adverse position of us, right? So we had plenty of capital sitting there, but no borrowing capacity. They had heaps of borrowing capacity, but no capital. And it just so happens that he found a great site in the eastern suburbs. The 4-townhouse site was DA approved.
Wow.
Wasn't really properly listed anywhere. It was on real commercial. It wasn't on real estate or anything like that. And we picked that up for a great price suburb? In Waverley.
Wow.
So we created a JV, went in together on this project, and that actually worked really well. It was a really fortunate set of circumstances.
Explain to people how sort of that agreement works and how sort of, lending, borrowing, purchasing and the project sort of goes together if they're thinking about a JV. Yeah,
so you're looking, I guess, at the overall picture there when it comes to how a JV works. You've got 4 stakeholders, essentially, him, his wife, me and my wife. We create an entity essentially with, and if you're going to do a JV, obviously get advice on this. I think that's where, having a really good team, we share the same accountant, these guys and us. And the accountant was able to sit down and go, hey, here are your options, talk through your objectives, here are your options. And, we set up a structure that worked for us, essentially a PTY LTD. And then, that PTY LTD, if it's successful in the development, will then allocate out, consultancy payments to respective companies that we hold. Mm-hmm. And that's how we sort of make it work. But, you're looking at the borrowing capacity, these guys have tons of it. When you combine that with ours, which is we've got enough to get it across the line with the additional capital and whatever else. So that worked really well.
How long friends were you with these people?
We'd known them for a while, but we weren't, I wouldn't say, we were had any sort of deep relationship with them. We weren't friends for a long period of time. We'd known them professionally for a few years. He's also in the mortgage industry. I respect him a lot and I learn a lot from him professionally over the years. What we found is we had a real similar sense of values, and they're very much the same as us. They're mad about property. They love development. They've been through the process and the experiences before. They've had lessons and learnings that they've taken out of those experiences. Yep. The same sort of risk profile. Everything sort of felt right with that. And I think I was very apprehensive at the start, and I think they were also very apprehensive at the start because they're similar to us around forming a JV and doing this together. But in hindsight on that one, very glad that we did.
What are the Waverley? What did you pick the site up? Like, give us some high level numbers if you can.
Yeah, high level. I think the site cost us about 4.4, and I think it cost us about 2. And
to build.
Yeah.
Wow,
it's a compact site, 4 bedders in a sort of laneway near a school. I'll show you later on.
Yeah,
but it was it was quite an easy process, to be honest. The builder we had, fixed price build contract, everything went swimmingly.
Has COVID been announced yet?
Not just yet.
Okay.
But we had to think about, right, so with that project, because you got 4 of them, you got to think about, well, how are you going to sell them? Mm-hmm. So we went, okay, well, we'll try and sell off the plan. So we ended up securing 2 of them off plan, knowing that we wouldn't get a premium price because, you're selling a piece of paper, so to speak, and selling a dream.
Yep.
But that gave us security and sort of a baseline around, okay, we know what we're going to get on this project now. Mm. And when we get to the end of it, we're not going to have this thing sitting around waiting a long time to sell, costing us money that we've invested. Yeah. And it was probably a good call that we did, because when we got to the end of that project, we had the 2 finished ones to sell. The first one came up late 2019, sold for a fantastic price. Then we listed the last one in 2020.
Okay, but you've sold the 2 off the plan already. What did you sell them for?
I wouldn't be able to tell you the exact figures off the top of my head.
Okay.
But I mean, roughly, I think we got about 10% lower on the off the plan sales, and then we had a probably it was like 20% higher on the third one
because it was and
then the last one was basically in line with the off the plan ones because we sold it. We exchanged contracts on the weekend of lockdown, and that's when it felt like the sky was falling, as everyone
thought.
So we thought, well, this is it. We need to get out of this, and we've done well on this project, even if we take a lower price, and we can move out of it and move on to whatever's next.
So we timed it probably just before the end of the world, and before property prices went up 30-40%.
Correct. Yeah, and if we had held on, of course, we would have been worth a lot more. But there were other opportunities waiting for us with COVID.
So the good thing, you probably timed that really well because you said you've made a profit. I suppose you maintain a relationship with your friend. Everyone gets their slice of the pie. The world's caving in and the fire sales and, all that kind of stuff happened and the opportunity of COVID. How well did you do? Did you pick up, one site, 5 sites, or what were your thoughts at the time and with development and also with your broking business?
Yeah, it was a real shift again, I think, with COVID. First and foremost, I suppose the broking business really was in a position now where it had benefited from, an enormous amount of focus on my end. And, I'd gone from working bugger all to, trying to pump out 60, 80-hour weeks, trying to build this thing up. And I'd hired my first staff member late 2019. Then the decks started, whatever it was, February 2020. And at one moment there, it looked like everything was going to shut down. And then next minute, all the rate cuts, 1.89, 1.79% interest rates. Absolutely everybody I've spoken to for the last few years wants to refinance, wants to lock in a cheap rate. And so we went absolutely bonkers.
Really?
I think by the end of 2020, I'd hired another couple of people to help out with the admin and whatever else. And business had completely transformed. So that was obviously fortuitous for that business. But then for development, we had borrowing capacity again. And, the businesses started to tick along, so that was helping as well. But we had plenty of capital sitting there going, okay, well, it's time to do something else.
Yep.
We were lucky enough to land a site. We actually bought, it's not identical, but it's very close. So we bought 2 vacant land subdivisions. So we bought one in
the east?
One in Bellevue Hill and one in Balmain East.
Wow. Okay.
So both of them were off market. Yeah. And so we did very well because it felt like the sky was falling. People were looking to get out of assets. And we thought, okay, well, first the Bellevue Hill one came about. We thought, okay, well, all we want to do at this stage, thinking long and hard around, what's going to happen with, asset prices and, all that kind of thing. Okay, there's a lot of risk. So, with COVID, everything sort of changed for us in terms of mindset too. And went, okay, well, what we're going to do is, spend a bit more time on us and, buy a family home, all that kind of stuff. And, we landed the site in Bellevue Hill and it was like, okay.
Was it a 4 townhouse site?
No, just an individual house build. It had a DA from 10 years ago, which no one could really tell if it was active or not. So it kind of felt a little bit risky. But we thought, okay, at the end of the day, we should be able to break even on this thing. Even if we don't make any money out, it's a way to get into the eastern suburb market. We can do it in a way where, at the end of the day, we've got a beautiful 5-bedroom home where the family can live long term. Tick pretty much all the boxes for us around what we want, and it's a great base to sort of enjoy that balance of lifestyle and whatever else, which we said we would do when COVID hit.
Did you leverage too much into that property, or was a lot of that leaning on the profit of the previous development?
Yeah, we actually bought in cash because we were sitting in a pretty.
So you done pretty well off the way.
Yeah. Well, it all just rolled over, right? And I mean, we hadn't done anything crazy with our money, right? All we would do all the time is throughout that journey is just recycle the money. We make money, put it more into more property, just keep it rolling over. And we had sold down a couple of properties, so we had more capital sitting there. I think today I have to actually check exactly how many properties we own, but I think we've got 8.
Mm-hmm.
So it's a long way down from a peak of 14. But, that sort of enabled us to have more capital available. And at the time we bought Bellevue Hill, we had to buy it quickly, had to make an offer attractive. So that's what we had to do.
Or cash offer, yeah.
Yeah, and then off the back of that, building the construction, we borrowed money for that. So, some niche ways you can do that without a fixed price build contract. So went down that path and, got the build done eventually. It did take 3 years.
3 years?
But we had...
This is shutdowns and all that kind of stuff, right?
We had shutdown, number 1 and number 2. We had...
I can't feel too sorry for you, though, if you bought the land in cash. So.
It's okay. Yeah, life was okay. We survived through it and, at the end of the day, we're really happy with where we landed on it. And, just so happened that, asset prices did go bonkers, which worked very well for, obviously, the projects that we were doing.
And I mean, if you're in the peak, Bellevue Hill is probably one of, if not Sydney's most expensive suburbs, around sort of Vaucluse and that too. So, is that that house? Have you sold that, or that's the one that you've sold that?
We've still got that.
You've still got it.
We've still got that, and we've got another one that we've acquired late last year up the road.
Mm-hmm.
So we've got a bit of thinking around what we're going to do next, but we'll work that out.
Tell me when do the cars and that sort of reward come into the store, this picture, right? Because it's been a long journey. You've went through obviously some extreme circumstances. You've lost money. You've learnt. You've made money. You're a car guy at heart. We know that from the start of the story, and you were probably itching for a very long time to scratch the itch. So. When does that sort of come into play?
Yeah, I suppose there was a few cars I was sort of scratching around with, throughout that period of time, but nothing that was overboard. So had a C63 for a while, an RS3, just sort of cars that were practical and sort of made sense because I was driving a lot with work and could put baby seats in and whatever else. But it wasn't till. Yeah, I think 2021 or maybe late 2020. I actually can't remember the timing of it. We said, Mel and I've said, look, maybe we should continue this sort of, let's enjoy life thing and smell the roses a little bit because, COVID sort of changed the game around mindset and thinking, okay, well, anything could happen at any given time. And I think, financially, with it accumulated well beyond where we thought we would ever be. And it was kind of like, well, we'll continue going down this path and, business is going well, development's going well, both businesses are growing. So I think we can allow ourselves a little bit of an indulgence. And so we thought, we'll buy a secondhand supercar. So, when I had a bit of a look around, COVID asset bubble had already begun. And so, we're thinking, we've got a limited budget here, right? We want to spend $250K and maybe about buy an Audi R8 second hand. And, all of a sudden we're looking at, well, they're now $300K or more. And I don't know what's happening here with asset prices, but we wandered around and looked at a few dealerships, went down to a Ferrari dealership and went, where are your second-hand cars? Oh, they're all gone. And if you want to buy a new car, then, you're going to struggle to get supply because there's limited production and whatever else.
Yeah, it's crazy and all the issue with the chips and... Yeah,
so we looked at it and went, okay. And the salesman there said, do you want to come and price one up and, sit in a room and configure it and set it up the way you want it?
He's done his job, yeah.
We walked over and then there was a Ferrari F8 Tributo. It was sitting there in a showroom and I think it was one of the first they received. And geez, that's such a beautiful car. And here I'm thinking, the kid with the Ferrari on the wall and all that kind of stuff. And sat through the process, configured it, and looked at the price and went, you know what, that actually doesn't seem unreasonable. If you look at the price of secondhand cars here, there's only a delta of, say, $100K between a brand new car, warranty, servicing, everything included, and saying that's 3 years old. So it kind of feels like there's very little risk here, right? Just evaluating this the way we would a property acquisition, right?
I was going to say, how funny. Yeah.
And because it is at the price of a lot lot more expensive than a lot more of the properties we bought. So I went, okay, well, it's a bit of a mind shift. We thought, at the very least, if we this is a bucket list experience, right? We'll order this thing. It'll take 12 months to arrive. During that period of time, who knows what's going to happen with asset prices and whatever else. Probably not going to go down. So we'll probably be able to get in and out of this thing at a break-even point, right, after owning it for, say, 6 months. Obviously, COVID they printed so much money. And it wasn't a break-even exercise by the time it got here. The market for those things had gone bonkers. So you're looking at 20 or 30% over sticker price for resale.
Wow.
And, so we looked at them and went, oh, well, this is a fantastic position to be in by the time it arrived. And, we've got this brand new Ferrari. We're now in the money on it. We didn't buy it to make money. It was more about, okay, let's enjoy life. And, we drove it around. We loved it. And all of a sudden we started meeting different people, other owners of Ferraris, other owners of supercars. And in the vast majority of cases, there's a lot of alignment with these owners on, their stories, where they've come from, what they've done. And we got hooked on the ownership experience and being able to talk to like-minded people about business, about different things. And off the back of that, we went, hang on, well, I'm not sure that we really want to sell this thing. But that sort of led to buying another one. And, we've bought a subsequent amount of different cars over the last few years and have a bit of a program now. So we've really taken it to the next level with that. We've set a car club up called the Fast Lane, and we've got an inner circle group of owners that we do away nights and trips and different events and that sort of thing through there. And I just find it a great experience to have now because we can sort of mix in with like-minded people, and we're all car people, a lot of property people within that, and business owners. This is great discussion and great learning that comes out of that.
It's interesting because we obviously had Emil Jurassic on a few weeks back, and he said the same thing. He said because he's the Ultimate is one of 250 in the world, is that once he started going to the car clubs and talking to everyone and having that experience, the networking, and then he was telling us the business that he now does, like a lot of those people are in those areas. So it's really funny how, obviously we talked about at the start of this how bad it was to buy any brand new car at the start of your investing journey, but now that you're at the end and that you've done it, it sort of opens you up to a whole new, level of business and people.
Yeah, definitely. And look, that wasn't the intent to try and use this as a tool to open that up, but it's obviously it has opened different doors for us, and I think behind those doors you find people that are the same as you, and it's great to have that network. And I think if I was young and I look back at my journey and all the mistakes I made and everything we did wrong, if I had the network I have today to draw down on, advisory board of experienced people that have been through these things before, if I had them in my corner, geez, it would have been a completely different picture. I mean, everything happens for a reason, you get to where you want to get to ultimately if you're resilient enough and you can manage to push through those roadblocks and smash through whatever happens. But geez, it would have been nice to actually have someone in your corner going, hey, don't do this or do it this way, or here's a few hot tips along the way.
What's sort of your end goal or your destination now? Because I think one thing I've really liked about your story when we talked offline is that you didn't have the ego or sort of the attitude I see a lot of the time where people want to get to 50 properties. I mean, you said it's consolidated now. You've sold down a few. You're making very big numbers sort of in development. So, I mean, what's next? Is it just to keep doing this or?
Yeah, I mean, we really enjoy what we do. So, I mean, day in, day out, I genuinely enjoy running a mortgage business. We've got a team of 7 people now. So for me, the focus on that is to, I guess, come out of the shadows a little bit and, try and engage with more people and try and add more value to people. I share my experiences and try and help people on their journey. I genuinely love the thrill of, seeing people go from their first investment property through to building a portfolio. And you know, I feel like I'm well placed to be able to help people with that, given I've gone through it myself. So right now it's about how do I continue to build the business and scale that up so I can make some more choices around how I spend my time, because I still spend a lot of my time on the tools and you know, deep in assessment of applications and stuff like that, which is probably not the best use of my time.
Yep.
So I'm just trying to build the team, find the right talent to continue to build that. You know, we've got the property management business, which is in a similar position. You know, we're trying to find good talent to fit within that business and build that.
Sorry to cut you off. Are the properties in Sydney East? Is that?
Yeah, it's usually in a ring, Sydney, so probably 10 k's from the CBD. Quite a few properties in the eastern suburbs, probably the majority is in the west. So it's really where investors are sort of picking stuff up these days, as opposed to not a lot of people invest in the east based on sort of numbers.
Yeah, of course.
But so the focus is on, you know, building and scaling those businesses. Like Mel has landed herself with a business partner on the property management business. One of her staff have bought into the business, and I think that's a fantastic thing to see. You know, as you get people around, you become successful, and you know you can help use these businesses as a platform to set them up for success as well.
What's sort of one bit of advice? I'm just conscious of time. It's been a good chat, and I feel like I could go on. We'll talk offline. But what's sort of a bit of advice that you can give for people that want to do something similar, or maybe they're a bit earlier in their journey, and they want to get to sort of this level with the cars and the more expensive assets, like or that potentially something that you get from dealing with investors on a day-to-day basis? What's something that you can sort of pass on? Okay,
I guess probably three things. So number one is self-education. You got to focus on self-education, and if you know what you're heading into, whether that's being an investor or a developer, you got to start with that. Number two, self-education is great, but if you're not taking action and you're not doing something, then it's worthless. So you got to have the right mindset. You got to have resilience. You know, you've got roadblocks that are going to come up. I've given a million examples, and I can probably give you a million more that we haven't spoken about. So you got to have the right mindset to be able to push through that when something goes wrong. And then I think thirdly, you know, having the right team, having the right people around you. That's the biggest learning I've had. Is if I could have built my team and had them in my corner earlier, I would have made better quality decisions and got to a better outcome, at least quicker.
So, but your issue is with that is people are starting from scratch and starting with zero, right, like you, and potentially have to kiss a few frogs but before they get to the prince or princess. So is there any shortcut there, or?
I don't know what the shortcut is, if I'm honest with you. It's consistency. It's not get rich quick. It's get rich slowly. And that consistency, that grind, you know, it is compound. I mean, property is compound growth, right? It's compound growth and leverage. And so it's that consistency to compound your efforts over time. And if you stay true to the course, you'll get there. But you've got to really be committed to it. There's no shortcuts that I know of, unfortunately. But, you know, the key thing I would say is, look, I came from zero. So if I can do it, then anyone can do it.
Yeah, fantastic. And I think if you leverage off people like Richard and their team and their experiences, then you're well on your way. Rather than trying to, you know, start all this and find all these people yourself, it's like leaning on people that have been there and done it. Richard, the way we usually wrap up is I ask you as well, Richard Morgan, what is a quote you live your life by?
How about get rich slowly?
Get rich slowly. Very nice, very nice. But also, I mean, now you're doing it quick in the Ferraris and the McLarens and stuff. But look, Richard Morgan, really appreciate you coming on the Everything Property podcast, and I'm can't wait to see what's next in the garage.
Pleasure. Thanks for having me.